Imagine a giant of Wall Street, a firm entrusted with billions of dollars, pensions, retirements, global money flows, and then imagine that same firm admits a 100% loss on a major private credit investment, not a 20% loss, not 50%, but all of it. If you believe the private credit market is safe, elite, insulated, you might want to rethink that, because this isn't just a misstep. It might be the signal that the private credit boom, long thought to be the new safe haven beyond traditional banking, is beginning to implode. What if the very foundation of the shadow banking world is showing cracks, and a firm like BlackRock letting go of 100% of a loan might be the first domino? In this video, we will trace the origins of private credit, show how it rose to dominance, see where the breaking point lies, examine the fallout and failed fixes, and then tie it all back to what this means right now. Stay with me, because what you'll see may change how you view your pension, your insurance, and the institutions you trust. The story begins not yesterday, but decades ago, when banks, under increasing regulation after crises, found traditional lending constrained. Enter private credit, loans made not by banks backed by deposits, but by institutional investors. Private funds, hedge-style vehicles. The idea: bypass bank regulation, lend to companies, generate higher yields. Over time, this alternative credit sector exploded. Firms like HPS Investment Partners were formed, which the video's anchor firm BlackRock later acquired. The regulatory constraints on banks after the 2008 global financial crisis made this sector attractive. Less regulation, higher returns, deep pools of investor money seeking yield. Meanwhile, companies with weaker credit profiles, or companies that didn't want public scrutiny, turned to private credit lenders. As the sector ballooned to estimates of $2 trillion to more than $3 trillion in assets by 2024. The twist: private credit was built on the promise of bank-like lending without bank-like risk. But the risk was always there, just hidden. This setup laid the foundation for the rise. Once the infrastructure was in place, the boom happened. Firms raised huge private credit funds, offering institutional investors alluring returns in a low-interest environment. Companies borrowed at higher leverage. Private credit funds provided bespoke loans. Banks freed up capital for other uses. For a while, it looked like a win-win. The traditional banking system's constraints became a catalyst for the private credit sector's ascendance. BlackRock, sensing this shift, acquired HPS in late 2024, approx $12 billion deal to double down on private markets. With the sector growing rapidly, the logic was banks pull back, regulation gets heavier, so private credit fills the gap. The cause-and effect is clear. Tighter bank regulation gives growth of private credit, gives increased risk tolerance, gives layering of leverage and complexity. Yet beneath the surface, many of these loans lacked the transparency of bank loans, were less regulated, and often depended on favorable economic conditions. Low interest rates, rising asset values, strong growth. The stage was set, but this was also a house built on less visible foundations. The turning point arrived when cracks surfaced. In 2025, bankruptcies, such as those of First Brands Group and Holding subprime auto lender, triggered alarm bells in the private credit world. Both firms had reliance on private credit, leveraged loans, opaque structures, the risk, contagion beyond what was thought. On October 14, 2025, Reuters reported BlackRock itself brushed off concerns of wider credit contagion after these bankruptcies, but the message itself was a warning. Then came the shocking admission: BlackRock will take a 100% loss on a fund tied to a failed borrower in the private credit space. Reported by financial media outlets, a firm so large admitting full loss should shock the system. Why now? The cause-and effect: rising interest rates gives, tighter credit conditions gives, weaker borrowers gives, default risk increases, gives exposure, and private credit becomes real. The house of cards begins to wobble. With the breaking point reached, fallout began. First, investor confidence shook. Institutional investors in private credit funds asked, are these loans really low? Pension funds, insurers, etc., which had increased allocations, now scrutinized exposures. Regulators began to speak up. The governor of the Bank of England warned that these private credit failures may be the canary in the coal mine. Second, banks and other institutions linked to private credit deals found their own exposures. While private credit was assumed insulated, the interconnectedness became visible. Third, failure of funds or forced wind-downs emerged. BlackRock winding down fund invested in failed car lender. This isn't a benign niche market anymore. It's systemic risk territory because the size private credit is multi-trillion-dollar and the ripple effects can spread. While BlackRock plays down contagion, the chain reaction is in motion. Borrowers default, funds mark DO, institutional investors flee, credit dries, valuations collapse. The effect could be broad. The telling part, many fixes now being applied may be too late. Historically, institutions have tried fixes: tighter disclosure, regulation, stress testing. After 2008, banks were regulated. Private credit grew, but the same architecture of risk moved to the shadows. Attempts to apply bank-style safeguards to private credit have lagged. Regulators are chasing the problem because the fund structures, the opaque leverage, the less regulated private side, all hinder transparency. As one explicable noted, we have no idea what is going on in there regarding value of assets in private credit. The cause and effect. Risk moves where regulation is weakest. Boom, bust. Many reforms fail because they treat symptoms, not architecture. Now we are seeing similar patterns. Rising rates, weaker borrowers, hidden exposures. The attempted fixes may actually deepen the risk by encouraging belief that the system is safe just because the big brand BlackRock is involved. But when your giant admits a 100% loss, the belief may have been misplaced. Let's zoom out. The private credit market is estimated around $3 trillion plus, with forecasts heading toward $4.5 trillion by 2030. Meanwhile, we live in an era of higher interest rates, slower growth and tighter credit than in the boom years of private credit. The pattern repeats: 1980s junk, 2000s subprime, 2020s private credit. The shocking data: bankruptcies of companies exposed to private credit are rising. Regulators are voicing concerns. Large institutions such as BlackRock forced to admit full losses. This mirrors the early phases of the 2008 crisis. Isolated defaults, concern, contagion, bailout. The collapse of real estate finance in 2007 looked like isolated mortgage failures until the whole system froze. Now, the private credit market may be at a similar inflection. Also, institutional investor shifts. Pension funds allocate more to private credit, believing in yield. But if defaults mount, pensioners could feel the pain. In short, the same cause and effect loop is present: rising risk, hidden exposure, weak disclosure, crisis. The question: are we heading into a private credit meltdown? The admission by BlackRock of a full loss is a warning. The system is showing early signs of stress, and the consequences could spill out into the broader economy. New investment is safe just because it's labeled alternative or private. The private credit boom was built on yield and less regulation, not immunity from loss. The BlackRock 100% loss is a stark reminder. Systemic risk has shifted. The next crisis may not come from banks but from the private credit world, because the sector is huge, interconnected, and less visible. What happens in private loans doesn't stay private. Transparency and regulation lag the market. The architecture of private credit was built faster than the safeguards. Without proper disclosure and risk controls, large institutions can still fail, and so can the funds they bet. The private credit meltdown may be underway, but its full scale may not be visible yet. If you believe the risk is contained, think again. Because when large institutions admit full losses, the economy's rope lines may start breaking. The open-ended thought: if private credit was the new safe haven, what will the next safe haven become when this one fails? Are we already entering the era of sovereign debt crises, hidden non-bank financial intermediation, or another form of leverage that nobody is watching? The real question is, where will the pain surface, and who will pay for it? If this video opened your eyes to how elite investors, huge funds, and private credit markets operate, and how a firm like BlackRock taking a 100% loss could alert us to a broader meltdown, then the conversation matters. Subscribe for more deep investigations into how finance, power, and risk intertwine. Hit the like button if you believe we should watch not only banks but the hidden corners of finance. Drop a comment. Do you think private credit losses will trigger the next crisis? Should regulators act now, or is this still contained? And share this video with someone who thinks my money is safe in alternatives, because maybe it's not. The breakdown may have already begun. The warning signs are flashing red. Stay alert. Stay informed.